Hello everyone. In this lecture, I'm going to talk about free cash flow to the firm valuation. The broader topic is firm valuation or equity valuation. I focus on the method of the free cash flow to the firm valuation because it's one of the most common and universal methods of valuing a firm, although there are many other ways to value a firm. I focus on this one in this class because we have a limited amount of time to cover each topic area, and this is probably the most common approach among analysts, and it really captures the idea of what's referred to as absolute valuation. What absolute valuation is determining the value of an investment based on the cash flows that it will generate to the investor. Sorry, let me put in another word here. The future cash flows discounted back at the appropriate rate of return. And many of you have probably seen different valuation approaches. There's dividend discount models, which is the same idea. We take the expected dividends from the future that the firm is going to generate in the future to this and give those to the stockholder and discount them back at the required rate of return of that stockholder. There's another method called the free cash flow to equity method. It's very similar to free cash flow to the firm, but it measures the cash flows that will be generated that could be given to the stockholders of the firm. Free cash flow to the firm valuation is the amount of cash that free cash flow to the firm is the amount of cash that is available for distribution to all of the investors of the firm, including shareholders, stockholders, or debt holders, which would also include bondholders. There are 5 uses for free cash flow to the firm: pay interest to debt holders, pay off debt or principal reduction, pay dividends to shareholders, repurchase stock from shareholders, and buy short-term investments or other non-operating assets. This topic really brings together many of the topics that we've covered in class, including capital structure, weighted average cost of capital, financial statement analysis. And you'll especially see these come up with the assignment you're going to receive for next week, which is to read through a case and to value the firm in that case for acquisition by another firm. So what I'm going to do in this video is go through, explain what free cash flow to the firm valuation is, and then I'm going to work through 2 examples using the financial statements of 2 firms, and that should prepare you for the valuation you're going to do for the company in the case. So the free cash flow to the firm, sorry, that should be another F in there, is the cash flow available for distribution to all the company's investors after the company has made all investments necessary to sustain ongoing operations. So we calculate it as FCFF is equal to Nopat, which stands for net operating profit after tax, minus the net investment in operating capital. So that it's called net investment because a company, in order to continue to operate, has to make investments in things like inventory, accounts receivable, fixed assets like buildings and equipment and all those things. But we also get to deduct out increases in operating current liabilities such as accounts payable and accrued expenses. So Nopat is calculated as the earnings before interest and taxes multiplied by 1 minus the tax rate. And the idea here is that I there, we want earnings before we take out interest, because that interest expense is a cash flow paid out to the bondholders or to the lenders to the firm. And so they are investors in the firm, and that cash flow counts as part of the free cash flows to the firm. That's why we don't take it out. The government is not an investor in the firm, and so we do take out the the cash flow, the taxes, or we estimate the taxes that go out of the firm to pay taxes. Alternatively, free cash flows to the firm can be calculated as net profit plus depreciation expense minus the net investment in operating capital plus after-tax net interest. This second equation is the one used by the chartered financial analyst. Oh, I won't put it that way because that's not going to make a whole lot of sense. Here we go. Chartered financial or the CFA. That organization is kind of the gold standard in terms of financial analysis. You should get very, very similar results if you use either way. A lot of textbooks use this top one, and it's one that I commonly use as well. There's, again, not a big difference between these two calculations, and I'm going to, for purposes of our assignment, I'm going to show you this method up here, the first method. Net investment in operating capital is the change in the amount of total net operating capital from one year to the next. So what's the importance of operating? So the idea here is that when we value a company, we might be valuing it for different reasons. We might be valuing it to determine if the stock price that we see in the market is greater than or less than the intrinsic value, the value we get from looking at the fundamentals of the firm. And that's one reason why a lot of people do it. Another reason why is if the firm is going to be acquired or is going to merge with another company. And so we want to make sure that the stockholders and the investors in that firm get fair value, at least, for their investment in the company should it be sold off. So the reason that we calculate is important because in many cases, especially when the firm is being acquired, the only thing that's being acquired is the operating portion of the company. We're going to divide up operating assets and non-operating assets. And non-operating assets of the firms are things like cash, marketable securities, long-term investments, things that aren't used in the day-to-day operations of the firm. And so whenever the firm is acquired, those things don't go with it. Okay, those non-operating assets often don't go with the firm when it's acquired. Instead, those assets are liquidated. Usually they're pretty close to cash anyway, and given out to the stockholders. So that's the importance of operating. When we sell a firm or when we value a firm, we're really interested in the value that comes from its day-to-day operations. In another sense, too, when we look at the operating assets and the operating activities of the firm, what we're looking at is really the core of the company. It doesn't include any assets that we're not using for operations in the firm, and we're really just looking at the core of the company and the ability of the core of that company to generate cash for its investors and to continue the operations of the firm. So what are operating current assets? So they're current assets. So they're going to be assets that are expected to be liquidated, turned to cash in 1 year or less, and then operating. They're used in the day-to-day operations of the firm. So there's two operating types of operating current assets that are usually included in any valuation, and those are inventory and accounts receivable. And there can be other ones as well, but those are the primary ones, and those are the ones I'm going to ask you to use for your assignment. What are the operating current liabilities? There's two main ones, and then I'm going to add an additional one because it's one that I've included in the examples and one that's going to show up in your case that you're going to look at. So what are the operating current liabilities? These are, again, they're ones that are generated from the day-to-day operations of the firm, and they are expected to be paid off in 1 year or less. So these are going to be accounts. Sorry about that. Payable and accrued expenses. Accounts payable, they are spontaneously generated from the day-to-day business of the company. When the company buys inventory on credit, then that generates an accounts payable. Whenever an employee goes to work for a firm, that generates an accrued expense, an accrued wage in that case, because they don't pay you until you've worked the time, rather than before you've put in your hours. So that would generate an accrued expense in that case. There's another one I'm going to add. And in some of in at least one of the examples we're going to look at, there's short-term or current unearned revenue and long-term unearned revenue, and I believe that's also the case for the company that you're going to value. And so what unearned revenue is it's been revenue that has been received by the firm without the product or service being delivered yet. So in the case of the subject firm for your case, they have a subscription model where people pay, let's say, a year in advance. Okay, so they pay a year at a time. So whenever someone does that, that creates a liability for them because they've received the revenue from that subscription, but they haven't yet delivered the full service. And as that year goes by, more and more of that revenue is earned. But that does create a liability for the firm. So what are the operating long-term assets? So these are going to be primarily your fixed assets. So property, plant, and equipment. And again, these are referred to as operating because they're necessary for the company to continue their operations. Okay. So generally fixed assets. Also, we're going to see some unearned revenue. And long-term unearned revenue just means that the liability won't go away in the next 12 months, or won't fully go away in the next 12 months. It'll go away sometime in the future, so it's maybe a multi-year contract that's been paid for in advance. One item that I kind of struggle a little bit with, I've done some research on it, is goodwill. Goodwill is the value put on the balance sheet when one company, in general, when one company acquires another for more than the value of the assets, which is very common when one company buys another. They're not only buying the assets of the firm, they're also buying the reputation of the firm, the relationship that the firm has with its customers and its suppliers. So there's a lot of value there that's not just contained within the assets of the firm, and that has to show up somewhere on the balance sheet. So oftentimes when one firm purchases another firm, that will generate a value of goodwill. In the examples I'm going to work today, I don't include that in the free cash flow calculation. However, it's added in as a non-operating asset. And there's some debate about that, especially if, and I've valued firms that essentially just go out and buy other firms. In that case, I've used that as an operating asset, but this isn't, in the cases we're going to look at, it's not a part of the general operations of the firm to acquire other firms. So the net operating working capital is equal to the operating current assets minus the operating current liabilities. So that's net is operating current assets less the operating current liabilities. That's where the word net comes from. And then we have operating working capital, indicates that it is these are current assets and current liabilities. Total net operating capital is that net operating working capital up here, plus the operating long-term assets. So that's not long minus term, it's just a dash there. Net investment in operating capital is the change, the delta, of the total net operating capital from one year to the next. So calculating the intrinsic value of equity, the value of operations, so that's going to be the free cash flows, the future free cash flows, discounted back to today at the weighted average cost of capital for the firm. So for the free cash flow to the firm valuation, the appropriate discount rate is the weighted average cost of capital, because these are the cash flows that are available not just to the stockholders, but also the stockholders and bondholders and other lenders and other investors in the firm. So it's to all the investors, not just the stockholders. The constant growth model, there are several different models that we can use for discounting those cash flows back. A common one is called the constant growth model. If the free cash flows of the firm are expected to grow at a constant rate for the foreseeable future, then the following equation can be used. It's the value of operations is equal to, so the value of operations at a specific point in time is equal to the next year's free cash flow, not the current year's, but the next year's free cash flow, or I should say, not the most recent years, okay, but the next fiscal year in cash flow, divided by the weighted average cost of capital minus the growth rate. And we're going to work through a few examples of this too. Non-constant growth, and this is really kind of the most common case where you've got a firm that has not reached that level of maturity where its cash flows are growing at a constant rate. So a firm that has a constant cash flow, constant growth cash flow, tends to be a mature firm in a mature industry. So think of Coca-Cola, McDonald's, companies like that where they have saturated the marketplace. Walmart may be another good example of that. They've really saturated the marketplace with their product. The only growth consistently that they're going to see is from the growth in the population, okay, and a growth in inflation or growth due to inflation. And because really they can't grow more than that with their current product mix. Okay, so Coca-Cola is virtually everywhere in the world. Okay, Walmart isn't everywhere in the world, but in places that they're not, they've tried to go in and it hasn't worked out well, and so their growth opportunities are very limited. McDonald's is virtually everywhere in the world, so they really have limited future growth beyond just the growth in demand from an increasing population and a growth in revenues due to inflation. Okay, there's not a whole lot of companies that fit that fit that mold for being a constant growth company. And so for those firms, we would use a non-constant growth model. The idea is that companies will eventually die off, be acquired, or they're going to reach that point where they become a constant growth company, at least with their current product or service mix. And so if we use non-constant growth, so if the free cash flows to the firm are expected to grow at a non-constant rate, then the value of operations are normally calculated as the present value of the forecasted free cash flows during a forecasted period, plus the present value of a terminal value. So the terminal value is the value of the firm, or the expected value of the firm, at that point at which the constant growth begins. The terminal value can be calculated using either the constant growth discounted cash flow formula or a price multiple. In the examples we're going to work, we're going to use the constant growth discounted cash flow formula. So the intrinsic value per share, this is the value. When you hear the word intrinsic, it means it's the value based on the fundamentals of the firm, not the market price. Okay, so we oftentimes compare that intrinsic value to the market value of the firm to see if if we believe our calculations are correct and accurate, then we trust that intrinsic value, and then we see if the market value deviates much from that to see if the company might be a good investment or might not be a good investment. So the total corporate value is equal to the value of operations plus the value of non-operating assets. The intrinsic value of equity is equal to the total corporate value minus any debt and to be specific here, interest-bearing debt. So not just any liability, but those liabilities that generate interest to investors. Oops, leave that out. Minus any preferred stock. The companies we're going to look at don't have any preferred stock, but we would also subtract out the value of that preferred stock to find out the intrinsic value of equity to common stockholders. Okay. So that's a very brief approach, and we're going to work through some examples of that on how to calculate the value of a company. The next part of this topic is mergers and acquisitions. So if you think back in one of our earlier topics, I think it was our second topic. It was first topic that we covered in this class. We also talked about spin-offs. In this case, we're talking about mergers and acquisitions. So the term merger is misleading. Mergers are actually quite rare, where two companies come together and they combine to form a better, bigger company. In most cases, it is, even if it's called a merger, it's really an acquisition, where one company is purchasing another company and they're not coming in as equal partners. So I'll give you an example of one. Back in the late 1990s, I worked for a bank named Nations Bank, and a few of you may have heard of it or remember it, but at the time it was the largest bank in the United States. Not long after I started working there, they were in talks with Bank of America. Now, to kind of put this in perspective, in the 1990s, prior to actually the mid-1990s, banks couldn't branch outside of a state, or if they did, it was very rare. So banks were generally contained within a state. Okay, so you'd have, Commerce Bank of Kansas or Commerce Bank of Missouri, but they weren't the same bank. So banks were limited in their geography. Okay. And so after some changes in banking law occurred, there was a bank on the East Coast, headquartered in North Carolina, Charlottesville, North Carolina. It was Nations Bank. I did some training there at their headquarters for about a month and a half. Got to meet the person that would eventually become the CEO of that bank. Got to go up in Nations Bank Tower and have lunch in the executive lunchroom. It was a lot of fun, kind of interesting. But that's where they were headquartered out of, and really Nations Bank reach was primarily on the East Coast and into the Midwest. So I worked in Missouri, and we had a Nations Bank there. On the West Coast, however, we had Bank of America, and that was headquartered in San Francisco. And they really covered the western part of the country. So Nations Bank wanted to be a national bank, a nationwide bank, and so they acquired Bank of America. And when they did that, and you probably have heard of Bank of America, when they did that, they took on the Bank of America name because it was more widely accepted, but everything else was Nations Bank. They kept the CEO from Nations Bank, the board of directors from Nations Bank. In theory, the CEO of Bank of America was supposed to eventually replace the CEO of Nations Bank, but that didn't happen. He got a nice send-off, and so they put in the person that I got to meet, Ken Lewis, as the CEO, who during the financial crisis did some really stupid stuff and got fired. But anyway, but that's how acquisitions often occur, or mergers or acquisitions often occur, is when one company comes in and purchases another company. We're going to talk about how those get paid for here in a few minutes. But how do mergers and acquisitions affect the value of the firm? And it depends on if you are the acquirer or you are the target. So for target firms, so the firm being acquired, so the value of the firm in terms of its market value of its equity usually goes up quite a bit after they've been, a firm has been identified as a target for an acquisition. Their value goes up a lot because the acquiring firm usually offers a fairly high premium for that company above what the current stock price is. And so if you happen to own the stock of a company that becomes a target, you're usually pretty happy because your stock price, the value of your stock just went up. Acquirers tend not to fare so well. And we're going to get into this in more detail when we talk about how acquisitions are paid for. In general, and it's saying I didn't do that right. Here we go. That's better. All right. Tend not to fare so well. In general, the justification for an acquisition, and in this case I'm lumping in the term merger with that, is that the firm will either I'll just say resulting firm will either benefit from efficiencies or so this would be when one company is doing something that's similar to what the acquired firm does. And in the case of Nations Bank, that was the idea behind the acquisition. The justification for the acquisition is where the two banks were overlapping, they could shut down branches because there would be no point in having two branches across the street from each other for the same bank. In fact, this happened recently here in Topeka when Capital Federal purchased Capital City Bank. I live near 29th and Wanamaker, and there was literally a Capital Federal branch on one side of 29th Street, and on the other side of 29th Street, in the same location, there was I think it's Capital City Bank. I believe that's correct. Branch for that bank, and so they shut down the Capital City branch, and that is an efficiency that they earn. They reduce cost by doing that. Okay, so we can reduce cost, or there can be some synergistic effects from crossover between what the companies do. A good example where this worked out well is when Pepsi purchased Frito-Lay. So this happened several years ago. Pepsi and Frito-Lay make two very different things. Pepsi makes soft drinks, water, juices, things you drink. Frito-Lay makes generally salty snacks, and those two things tend to go together pretty well. And so this was actually is seen as a good acquisition by Pepsi because they could then co-brand and co-market the different products. So when you go to the grocery store, you might notice oftentimes on the end caps for the soda aisles there are Frito-Lay products, and that's not by chance. That's because Pepsi co-brands the two together. So for example, I believe it was in the previous year, Pepsi did a co-branding commercial with their chips and Mountain Dew on a Super Bowl commercial. And so they've done that, and that's actually worked out really well for them to co-brand their products together. Acquisitions and mergers don't always work out well. The one I told you about with Nations Bank and Bank of America actually ended up decreasing the value of their stock in the long run, which made me feel a little better because I quit that job before my stock options vested, and so I got to look years later and see my stock options would have been worthless anyway. So I felt good about that, but a lot of their stockholders didn't. So what are the synergies that can result in a higher value? Are there synergies that can result in a higher value? How are they incorporated in the free cash flows of the firm? And then I've got another question down here. What is the appropriate capital structure and what is the appropriate discount rate? And so these are questions that you're going to have to answer. I'm going to talk about them a little bit here. But for the case that you're looking at, it's going to depend on how you answer these questions is going to depend on the point of view of the person who is valuing the firm. So if you're looking at a situation when one firm is acquiring another and you happen to be the target, you might want to take into account the value that's going to be created or the expected value that's going to be created through the acquisition. So if one company is coming to you and wants to buy your company, you're going to want to adjust that price, hopefully, based on the benefits they're going to receive from purchasing your company, and not just your company alone, as an asset or as an investment. Because the justification for an acquisition or the justification from a merger comes from the value created through that combining of companies. So if I'm on the side of the target, if I'm the target of that, I'm going to want to include at least some of those synergistic benefits whenever I determine what price I should sell my company to this other firm for, so they don't take all of the value from the combination. So are there synergies that can result in a higher value? The answer is clearly yes. I mentioned Frito-Lay and Pepsi. Synergies that reduce costs. So I mentioned removing costs or increase revenues, and as a result of increasing revenues, increase profitability. Those are things that can result in a higher value. And so again, PepsiCo did that successfully with its acquisition of Frito-Lay. How are they incorporated in the free cash flows of the firm? They should be incorporated as an estimate of an increase in the free cash flows of the firm to the company that exists after the acquisition. So they should be taken into account, hopefully by both parties, both the target and the acquirer. The degree to which they add value or add to the price, though, is going to be between the acquirer and the target, so they can come up with a fair price. The target has to recognize the value that's going to be created, but that they're not entitled to all of the value created, and likewise for the acquirer of that company. What is the appropriate capital structure? So again, you're taking two companies coming together, and it's going to depend a little bit on the size of the companies. So if you have the acquirer that's much larger than the firm being acquired, then it's going to weigh pretty heavily on the capital structure of that acquiring company. There's a gentleman by the name of Mayo Schmidt, and if you ever go down to the finance lab, you'll notice it is the Mayo Schmidt Finance Lab, and he's the CEO of a power company up in Canada. He's also a graduate of Washburn. And he came and spoke to my classes a couple of years ago, and he actually talked about a situation where his company acquired a much larger company. And they were able to do that, and it made sense for them because of the way that that much larger company had financed itself. They weren't able to purchase Mayo's company, but they felt like that there would be value created by combining the two companies. So he actually went the other way, and as a smaller company acquired a much larger company. So what's the appropriate capital structure? So the appropriate capital structure is going to depend on really the acquirer, not the target company, because that capital structure of the target company is going to go away. Okay. Now, if we're just valuing a firm for the purposes of determining the intrinsic value and to determine if the stock is fairly priced, we're going to want to use the capital structure of the firm that we're looking at. Or if they've got an optimal capital structure or a target capital structure that they've identified and they're working towards, that might be a good choice as well. However, if the firm is being acquired, we want to take into account the acquirer's capital structure, and importantly, for the case you're looking at, how is the acquisition going to be financed? Okay, so some things to consider here. So, what is the purpose of the valuation? If it is to determine what the appropriate value of, to determine if the firm is currently over or underpriced. I'll use the word mispriced here. Mispriced in the market. Then use the firm's existing capital structure or their target capital structure. So again, if they're actively moving towards a specific capital structure, you might want to use that. But the existing capital structure really kind of gives us what it should be valued in the marketplace right now, because we're using that capital structure to determine the value. Hope that makes sense. If the firm is being valued for the purposes of an acquisition, sorry, I should do this differently. Here we go. There we go. All right. If the firm is being So what is the capital structure of the acquirer, especially if the acquirer is a much larger firm? Okay. How is the acquisition being financed? And that is really going to be important, especially in the case you're looking at, because the potential acquirers, and there's more than one, are using different approaches, different levels of debt, and really would change the capital structure of the firm that they're acquiring. Then the last question here is, what is the appropriate discount rate? And again, it depends on the purpose of the valuation. In this case, for the free cash flows to the firm valuation, we want to use the weighted average cost of capital. The valuation is for an acquisition. Here's where it's important, especially for the firm being acquired, to determine if the new capital structure of the firm will decrease the weighted average cost of capital, because we know whenever a company decreases the weighted average cost of capital, the value of the firm increases. Okay. So if it's for an acquisition, we want to think about the capital structure that's going to result for the firm and whether or not that's going to increase the weighted average cost of capital or decrease the weighted average cost of capital. And again, your point of view is also important, because if I'm the firm being acquired and the new capital structure for the firm after it's acquired is going to decrease the value of the firm, in other words, the firm's acquired, but the required rate of return on that firm now is higher. I don't want my price being discounted because of that. Okay, I don't want the value of my company to be undervalued because an acquirer is going to come in and increase the required rate of return. I hope that makes sense. They're going to do something to the firm that makes it worth less. So that's a decision being made by the acquirer and shouldn't come into play for my decisions. Okay. However, if they're going to create a benefit by the acquisition, I don't want all the benefit to go to the firm that's acquiring the company. So So you should look at the existing weighted average cost of capital for the firm and the resulting estimated weighted average cost of capital for the resulting company. In the case that you're going to look at for next week, the company that's being acquired is not being combined with another company that does something similar. The company, well, there's two companies, and I should actually back that up a little bit and say there's two potential acquirers. One company, one of those acquirers does do what the firm that's being acquired does. They're in the same area. The other firm that's acquiring the company, what they do or trying to acquire the company, they are actually in the business of acquiring companies, and so the company would exist kind of as a standalone investment for this firm, the parent firm. And so that's something to maybe take to some consideration for, is whether it's going to be kind of merged into and devoured by an acquiring firm, or it's going to be held as a standalone firm. But we want to take a look at the weighted average cost of capital, and especially as the target company, okay, the one being acquired, if that acquisition is going to create value, then again, I want my stockholders and myself as a stockholder to benefit from that, and benefit for going through that process of being acquired. And so I want to receive some of that value if value is being created there. I hope that makes sense. So how are mergers and acquisitions paid for? There's three ways to pay for a merger or acquisition. Because essentially what you're doing is you're trading value for value. You're trading something of value for the value of that firm. and the firm is being acquired from the stockholders. Okay. The first way is cash only. Cash only generally provides the best results. Especially if the acquirer is using cash that it has on hand. In other words, they're not taking out additional debt to pay for this firm. They have plenty of cash. Think of Apple with hundreds of billions of dollars in cash or near cash assets. They can easily go out and acquire firms. We usually see the best results from these, and it's odd because of where that improved result, that improved outcome is usually because the acquiring firm is getting rid of excess cash that they might use to do something dumb. They're getting rid of excess cash. They're buying an asset in this firm that will hopefully generate an appropriate return for its stockholders, but certainly better than what they've got the cash currently invested in. So that's the first way. Again, it generally provides the best results overall. Stock. So when this occurs, the stock of the acquiring firm, I'm probably not going to spell that right. Oh, I left something out there. There we go. Is exchanged for, is given in exchange the stock of the target firm. So this happens quite a bit. Whenever Berkshire Hathaway acquired BNSF Railway or Railroad, that's how they did it. Primarily, or at least in part, they gave shares of stock, of Berkshire Hathaway stock, to the stockholders of BNSF. And at that time, the B shares of Berkshire Hathaway were divided up, and the value was brought down to $75 a share, and at that price they could exchange shares with the stockholders of BNSF. Generally not the greatest way to pay for a company, especially in terms of outcomes. Like I said before, a big benefit from using cash is that the cash that's being used is generally excess cash, or even if the firm is paying, getting that cash through taking out debt, it locks up some of the future cash flows of the acquiring firm, and that's oftentimes seen as a benefit because they're getting rid of discretionary cash in the future. And what we know from companies that generate too much cash that they're not using is that it actually creates a free cash flow problem, and I'll come back to that here in a minute. But generally, this produces the worst results. Not always bad, but oftentimes not great results. If you are a stockholder in a company being acquired and they're exchanging shares of stock for your shares of stock, in general, not always, but in general, the best thing you can do is sell that stock as soon as you get it. Because what we see in research is the stock price for that remaining stock, the stock that exists after the acquisition, generally goes down when all of the synergies and the benefits of the merger or the acquisition don't materialize. And then the third way is a mix of cash and stock. And kind of as indicated from the first two items, the results are mixed. Okay. So in general, when a firm purchases another firm with cash, that's when you get the best results. The worst approach is generally when one company purchases another company with stock. And by the way, that BNSF Railroad acquisition, it's rare for Berkshire Hathaway to purchase another company with its stock. Okay, generally they do cash purchases. So I said I'd come back to this idea. So the cash is a benefit. So the free cash flow problem is an agency problem. That occurs when a firm has or generates more cash than it needs and does not pay that cash out to its investors. So if they're sitting on a bunch of cash, or they're generating a lot more cash than what they need, this can result in what's called a free cash flow problem. And the idea behind this is pretty simple. When people get extra cash that they don't have a use for, they tend to do dumb things with it. Okay, they tend to go out and blow it. And managers and firms are not any different in that case. You know, they've got an extra pile of cash. They decide, hey, let's go build a new building, or let's go buy some airplanes, or let's just do something dumb with it because it's fun. Let's increase everyone, all the executives' pay and increase the compensation for board members beyond what it should be. That's pretty common for firms, and so alleviating that free cash flow problem, kind of sucking up all that extra cash, either the cash the company currently has or the cash that it's generating in excess of its needs every year, and using that for an acquisition provides benefits. Okay, it provides value creation in cases where there wouldn't be value created. And that is the notes for this topic. The next thing we're going to do is work through a couple of different problems where we're going to value the firm. All right. So I'm going to open up a spreadsheet here. So the first company we're going to look at is Coca-Cola. And the workbook I put out online for you has the income statement, the balance sheet, the statement of cash flows, and then I'll rename this here, the free cash flow to the firm valuation. So what we're going to do is we're going to estimate the free cash flows for the years 2015, 16, 17, and 18. We need an additional year here for the balance sheet items to calculate that change in net operating capital investment. All right, so what we'll do then is calculate the free cash flows to the firm, and then what I typically do is, using the historical free cash flows, make any adjustments that I need to, and then use that as an estimate for the free cash flows going forward. In this example, we're going to calculate the free cash flows to the firm and then use that last year estimate as the free cash flow to the firm for 2018, and then we're going to value this firm at the end of 2018. Okay, so the operating profit for the firm, we find that, and by the way, that is EBIT, that is earnings before interest and taxes. In these financial statements, it's the title for it in the income statement is operating profit, but this is EBIT. So we're getting that net operating profit after tax. If you look back in your notes, we talked about where that comes from. So we take the operating profit from the income statement, and we're going to start with 2015. So I've got here operating income. There we go. Oops. And then I need to make that show up there. And then I'm just going to pull this across for each of the years. And it's interesting here, so we can see EBIT declining for 2 years and then increasing. And let's just take a look at their balance sheet. So this is an interesting thing to point out for McDonald's during this time period is actually their revenues were falling. So the demand for their products and the desire for people to purchase their products was actually going down. The tax rate is going to be the effective tax rate, and that's also found on the income statement. So if we scroll down here, we've got at the end the income statement, or excuse me, the effective tax rate, and this is for 2015. And again, I need to point that in there. I'm going to drag that across too. We can see that their effective tax rate each year is around 23% here, 19 or close to 20% here, 19 or close to 20% here. In 2017, it's really high, and that is because if we look at the net income each year, McDonald's had a fairly low net income in 2017 because of the unusual items. So we can see here that it's fairly stable. It's actually really stable. Earnings before taxes, excluding unusual items, is pretty stable across the board here. But then it took a drop if we include the unusual items, specifically the loss on the sale of assets there, impairment of goodwill here, and those two are pretty high and really explain the difference here between the different years. And so this kind of odd year in 2017 is really due to unusual items. So our net operating profit after tax is equal to operating profit multiplied by 1 minus the tax rate. And then depreciation expense. On a lot of income statements, especially the Capital IQ ones that I'm using, depreciation expense doesn't show up on the income statement. So you can see here it's not on the income statement. So I'm going to actually take that from the statement of cash flows. So I'm going to put in equals for 2015. Go to the cash flow statement. Depreciation and amortization for 2015 is $17.53. And you can also put in here an amortization. It's fine to, this is added in because it's a non-cash expense. And amortization is as well. It's generally not very much for these types of firms. Okay, I'm going to pull that across. So that's everything from the income statement and the statement of cash flows. Well, we'll add one more thing from the statement of cash flows here in a minute, and that's the investment in gross fixed assets. So for this section, I want to include everything from 2014 through 2018. So our investment in gross fixed assets is just the value of the gross fixed assets on the balance sheet. So I'm going to go here to gross property, plant, and equipment. So equals. Then I'm going to go here on the balance sheet to gross property, plant, and equipment. One thing to notice is that we did add back depreciation and amortization here. If we were using net fixed assets in this case, we would not do that. We would not add back depreciation and amortization. But because we're using gross fixed assets instead of net fixed assets, we do want to add that back in, or we would be using that depreciation twice. We do want to add that back in. So our investment in accounts receivable, we just go to the balance sheet for 2014 and select the accounts receivable. And then inventory, again, press equals, go to the balance sheet. And then inventory, accounts payable. accrued expenses. Okay, and then Coca-Cola doesn't actually have any unearned revenue. That's what we would look at it for down here. We don't have any other unearned revenue for Coca-Cola. So we go back out here to the free cash flow to the firm valuation, and we can actually grab these items and pull them all the way over. And then we can calculate the total investment in operating capital, which is going to be equal to our gross fixed assets plus our accounts receivable plus our inventory minus accounts payable minus accrued expenses. Then again, what I'm going to just do is drag that all the way over. So this is how much Coca-Cola has invested net of reductions from accounts payable and accrued expenses in their fixed assets that generate operating income for the firm and operating cash flows for the firm, and how much they have invested in accounts receivable and inventory, which also generate income for the firm. One thing to notice here is the significant reduction in time in the amount they have invested in operating capital. So we see here they had $23 billion or $24 billion invested in 2014. That's been reduced to $13.5 billion in 2018. So a significant reduction in their investment in operating capital. We really see this here. A large driver of this is what occurred between 2016 and 2017. We see their investment in gross fixed assets fall by about $5 billion, or about 20% of the, about 20% or so of the amount they have invested. So they really did disinvest and reduce the value of what they have invested during that time period. So the change in investment in operating capital is equal to the current year minus the prior year, or the more recent year minus the prior year investment. What we see here is that they've been disinvesting in operating capital. This is not a sustainable practice for a company to continually disinvest. So there's going to be some point in time where Coca-Cola stops this. What it does in the meantime, though, is it actually increases the free cash flows to the firm, because this is cash coming back to the investors from the company, reducing their investment in the firm. So the free cash flows to the firm in this case are going to be equal to Nopat plus depreciation and amortization minus the change in investment in operating capital. And because that's a negative number in this case, it's actually results in an increase in the free cash flow to the firm. So pull that out there, and then we can calculate the annual growth. So we see a 17.2% reduction in free cash flow. 2016, 2017 it's negative 28, and then in the last year it is 18.79%. So this reduction here in 2017 was due to this very high tax rate in 2017. If we take a look at their income statement, we can see the net income also fell dramatically in that year. So we really wouldn't want to take into account 2017 as kind of a normal year for Coca-Cola. Clearly they divested in some of their assets, and some things they had a loss on the sale of assets that was pretty significant in that year, and that's non-recurring. If I were using these free cash flows to value a company for myself, I'd make adjustments to this. I'd probably change this to something more in line with what they are currently paying in terms of taxes, and that's what I just did there. I don't have to adjust for those non-recurring items because they're not included in my cash flow here. But I certainly would change that tax rate to make it more realistic for the firm. But we even see with that their free cash flows, overall declined during this period, and in the 2-year period also declined. And so, those are some of the things you're going to want to think about when you value a firm. The valuation you're going to do for the assignment is I'm going to give you the information you need to make those decisions. So no need to worry about that. So what we're going to do now is determine the value of operations for Coca-Cola, and I'm going to give you the inputs here. The weighted average cost of capital we're going to use is 9% for Coca-Cola, and then we're going to assume that Coca-Cola is a constant growth company. If anything, it might actually be declining growth, but for our purposes, we're going to call it a constant growth company. And we're going to say that those free cash flows, we expect them to grow by 4% indefinitely. So the value of operations in this case is going to be equal to, and like I said, typically what I do when I really get into a firm and value it is I try to come up with a kind of a free cash flow estimate for the previous year that's adjusted for any changes that are non-recurring. So what I'm going to do in this case, though, is I'm going to use the free cash flows for 2018. And this might be, even though they're the lowest ones of the 4-year period that we're looking at here, we do see a trend that their free cash flows, the earning power of Coca-Cola and the ability to generate free cash flows is declining because during this time period they did divest of some of their operations. So while this is a lower number, I wouldn't say that it's an out of line number. So I'm going to use the value of for the value of operations, I'm going to use the free cash flow for the firm for 2018, and I'm going to multiply that by 1 plus the constant growth rate of 4%. If you look back in the notes, this is the calculation we do. Take the previous year's free cash flows of the firm, multiply it by 1 plus the constant growth rate, and then we divide that. And that's okay there. Then we divide that by the weighted average cost of capital minus the growth rate for the firm. So that's our constant growth equation. We get a value here of $192,169 million. Actually, what I'm going to do, I'm going to move this equation to here. So that's our value of operations as of the end of 2018. Our non-operating assets for Coca-Cola are going to consist of cash and equivalents, short-term investments, long-term investments, goodwill, and other long-term assets. So my cash and equivalents are going to go to the balance sheet. I'm going to use, again, the most recent values for this. Cash and equivalents of $8.926 billion, and here I can just drag it down for the short-term investments as well, because it's going to go to the same sheet and just grab the cell below it, which is the short-term investments. Then I'm going to go to the balance sheet and long-term investments. Goodwill, $10.263 billion. And then other long-term assets of $2.88 billion. Right? So our total corporate value, the total firm value, is going to be equal to the value of operations plus the value of non-operating assets. Okay. So then we want to take out the interest-bearing debt for the firm. So this is going to be equal to, and again, I'm going to go to the balance sheet and the most recent year. So my interest-bearing interest-bearing liabilities consist of short-term borrowings plus the current portion of long-term debt. And what that is that's the part of the debt, the long-term debt, that's going to come due in the next year. So if you think about maybe you have a mortgage loan on your house, the portion of that loan that's coming due in the next year would be the current portion of that long-term debt. So my interest-bearing debts in this case are the short-term borrowings, the current portion of long-term debt, and the long-term debt for the firm. So in finance, we usually refer to those as prior claims on the value of the firm. And so we have our total corporate value, the value of the entire company, minus the prior claims on that value by debt holders. There are no preferred stockholders with McDonald's. And then we're going to take that value of equity, divided it by the shares outstanding. So our shares outstanding we go. So we can use either one of these. They're pretty close. Shares outstanding on balance sheet date, shares outstanding on the filing date, which is often about 3 months later than the balance sheet date. I'll go ahead and use that one. Again, it doesn't really matter in this case because they're so close together. And that's not going to be a dollar amount. That's just a number. And so I'm going to divide the 199,214.55 by the 4275.34, and that gives us a value per share of $46.60 for McDonald's. Now we can go back and look up what the value was at that time. So if we look back here, actually look at it today and it's pretty close to that value. But look back here, the end is $46.86 on the first day of January. So very close to the value we got of $46.60, like 26 cents off. Part of that was done on purpose because of the choice here I did for constant growth and weighted average cost of capital. But these are also fairly reasonable estimates for those. So that is how we would value Coca-Cola. The second firm that we're going to value is Oshkosh Corporation. Oshkosh Corporation is a company that builds specialty vehicles, and these include aerial work platforms. They include fire trucks, fire engines, a lot of large military vehicles, trash trucks, things like that. I picked out Oshkosh because it does have some similarities on its balance sheet. For example, I mentioned in the last valuation unearned revenue. They have some unearned revenue on their balance sheet. I want to show you how that works into the estimate. And also, this is a non-constant growth company, so we're going to, instead of assuming that the growth rates are constant now, like we did with Coca-Cola, now we're going to look at a situation where we expect there to be some high growth for a while and then it to drop off after a certain number of years to a constant growth rate. And I'm going to show you how to model that in Excel. So that's the company we're going to look at now. I put out the financial statements and the information we need on Excel. What I've also done, because it relates to your assignment, is I'm going to have you do a quick calculation of the weighted average cost of capital to kind of bring that back in from our previous lesson on that topic. So I'm going to do it here for you. I give you the information in the case study for Renaissance Learning for your assignment for next week, so you can calculate the weighted average cost of capital. And then you're going to use that to determine the value of the firm. That's going to be our discount rate. So why don't we start with that? Over here, I've given you the beta, the risk-free rate, the market risk premium, the cost of debt. That's going to be, for Renaissance Learning, it's going to be the yield, I believe the yield on their long-term bonds. I'm going to go over that when I get to after this video. And then the tax rate for the firm. So the cost of equity, or the required rate of return on equity, we're going to calculate using the capital asset pricing model and the security market line. So I'm going to go through it here, but it's also back in your notes on the weighted average cost of capital. The way we calculate this is that we take the risk-free rate plus the beta for the firm, and that beta multiplied by the market risk premium. And we get a required rate of return here of 13.27%. So again, it's the risk-free rate plus the product of the beta multiplied by the market risk premium. The amount of equity, we're going to use the balance sheet values here. So if I look on the balance sheet, and I'm going to go to the most recent year end, total equity is 2513.5. So we'll go back here, equals 2513.5. And the amount of debt, and this is going to be our interest bearing debt, is going to be equal to the short-term borrowings, which are 0 in this last year. Our current portion of long-term debt, which is also 0, so I'm not going to add those in. I would if there were a number there. So in 2017, they did have both the short-term borrowings and the current portion of long-term debt, and I would add those in if those were positive numbers here. So we're going to have the long-term debt, and that's going to be all of our interest-bearing debt for Oshkosh at this time. So the weight of equity is going to be equal to the amount of debt, or excuse me, the amount of equity divided by the equity plus the debt. And then the weight of debt is equal to the amount of debt divided by the amount of equity plus the amount of debt. And remember that these two numbers, the weight of equity and the weight of debt, need to sum to 1. So our weighted average cost of capital is equal to our cost of debt multiplied by 1 minus the tax rate multiplied by the weight of debt plus the required rate of return on equity multiplied by the weight of equity. So I get 10.88% there, and that's a reasonable number for this company. And if you have any questions, because I'm going back quite a ways in the class to get these formulas, please feel free to ask me. Send me an email if you have any questions about that. So now let's go to the free cash flow calculation. And so if you remember from the Coca-Cola valuation, what we put in here was the EBIT for the firm. So here I'm going to put in equals and go to the operating profit or operating income. Just pull that across. And what we're doing, again, just like with Coca-Cola, we're valuing Oshkosh Corporation at the end of 2018. The tax rate, again, I'm going to go to the income statement. Down at the bottom, it's going to have the tax rate. Effective tax rate's right here. And this is nice. It's got a very stable tax rate over time. It did dip down a little in 2018. Our net operating profit after tax is then equal to our operating profit multiplied by 1 minus the tax rate. And again, pull that across. Depreciation and amortization, just like with Coca-Cola, I'm going to pull this off of the statement of cash flow. And so I'm using this number down here, depreciation and amortization total. The investment in gross fixed asset that comes straight off the balance sheet under long-term gross property, plant, and equipment right there. Take that across. And then we want to fill in these cells here. The accounts receivable goes off the balance sheet. The inventory, again, comes right off the balance sheet. Accounts payable, I'm just doing the same thing, just going to the balance sheet, getting the 2014 value. Accrued expenses. And remember, we don't put any interest-bearing debts on here because those are the result of financing decisions and not the result of operations for the firm. Unearned revenue current. And then unearned revenue non-current. And let's see here. And they don't have, at least not separately listed out, any non-current unearned revenue, but Renaissance Learning, I believe, does. So just keep that in mind as you're doing your valuation there. So I'm just going to pull all of these numbers over all the way there. So the total investment in operating capital is equal to the gross fixed assets plus the sum of accounts receivable and inventory minus the sum of accounts payable, accrued expenses, and unearned revenue. And if you want to, just because you'll need to do it for Renaissance, I just included that unearned revenue non-current in there as well, although it's not worth anything. So we get our total investment in operating capital for each year. So what that means is that in 2018, the firm invested $2.56 billion in operating capital. So increase their investment every year. Fairly consistency, and it's growing over time. So our change in investment in operating capital is equal to the operating capital for total operating capital for 2015 minus that of 2014. And so these positive numbers here are uses of cash. They're paying out money to invest. One year that they reduced, in 2016, they reduced their amount of operating capital. We can look at this and we can see what happened there. And it looks like their amount of inventory went down a lot. In 2016, that can be a good thing. Maybe they did a good job selling stuff. It certainly did not rise back up to the amount they had in 2015 during this time period. And that was the main driver of that situation, that negative investment in operating capital for 2016, is that they got their inventory down. So what we want to do here is for the free cash flows to the firm, we want to take Nopat plus depreciation and amortization minus the change in operating capital. We can see this is growing. It's not terribly consistent or stable over time. Our growth rates are 2,291% in 2016. 17, it dropped by 74.11%, and then in 18, it increased by 160%. So certainly, had some different things going on there. We're making the assumption that free cash flows to the firm are going to grow by 7% a year. And that's just something I'm giving to you here. I believe we're going to take a look at Renaissance Learning. That assumption may be given to you as well for that case. Okay, so we're going to grow this number here by 7% per year for 4 years, and then in the 5th year we expect the growth rate to fall to 2.5%, which is going to be our constant growth rate. Okay, so I'm going to take the previous year's numbers, multiply that by 1 plus, there we go, 1 plus the 7% in that cell to get 450.06 million. The next year is 481.56. The next year is 515.27. The next year is 551.34. And then the final year is just going to grow by 2.5%. for $565.13. Our terminal value then, and the idea here is that the amount we could sell the operations of Oshkosh Corporation for at the end of 2022 is going to be calculated using that constant growth model now, where we take the next year's free cash flow, we divide it by, try that again, equal to the next year's free cash flow divided by the weighted average cost of capital, and notice I put this in parentheses, minus the long-term growth rate of 2.5%. So we get a terminal value of $6,743,041. Okay. We're going to plug that. That's going to be our value. Oh, sorry. We're going to find the present value of these cash flows. So I'm just going to make another row down here to add up. Well, actually, I just need to add up this terminal value year. So the free cash flows of the firm for the future, 2019 we expect it to be 450.06. In 2020 we expect it to be 41.56. In 2021 we expect it to be 515.27. And then in 2022 we expect the free cash flows of the firm to be 551.34. And then the value of operations at that time, at the end of 2022, to be $6.743 billion. And that's what we could sell those operations for. And so we're going to say the value at that point, the cash flow we could receive at that point is $7.294 billion or $295 billion. Okay, so now what we want to do is we want to bring these values back to the end of 2018 because that's the point in time where we're valuing the company. So the value of operations right here is the present value of the future free cash flows of the firm. And in this case, it's going to include the $7.295 billion because that's the cash we could get, in theory, from selling Oshkosh's operations at that time. So in this cell, the value of operations, I'm going to put in NPV, open parentheses, the rate is the weighted average cost of capital. Then I'm going to highlight these cash flows. So I get a value of operations at the end of 2018 of right at $6 billion. So we're going to go down here to the value of non-operating assets. In this case, I have cash and equivalents. So you'll sometimes see this when a firm has a lot of excess liquidity that they're not using for their operations. That'll be included down here. And I'm going to use the values at the end of 2018. So at the end of 2018, they have $454.6 million worth of cash and equivalents. If they had trading asset securities, we'd also put that in too. So we would have another line down here for that. We've got one for short-term investments. And so you can see your total cash and short-term investments. They don't have any short-term investments, so that's just zero. Long-term investments. Oops. Again, go to the balance sheet. Long-term investments right here of $12.9 million. Goodwill, they have a lot of goodwill. And so the reason why Oshkosh has a lot of goodwill is that they've gone around and they've purchased a lot of companies. If you go to their website, you'll see JLG Aerial Work Platform. So JLG was a separate company until a few years ago, and they purchased JLG. I just think aerial work platforms are cool. And so when they purchase companies like JLG, that creates goodwill on their balance sheet because they pay more for the company than the value of the firm's assets. So it was quite large there, a little over $1 billion worth of goodwill. Then any other long-term assets. So we'll look on here, we'll go to other long-term assets at 37.3. Oops. Actually, we want to include the accounts receivable long-term, the deferred tax assets, the deferred charges. We actually want to include all of those, although they're not all under the heading. So these are all non-operating assets that increase the value of the firm. Okay, so we want to include so for other long-term assets, we're going to go to the balance sheet here, and we've got other intangibles of 469.4 plus accounts receivable long-term. We definitely want to count those because those are real cash flows that we expect to come in, real value that we expect to come in after the next year. We're not going to include deferred tax assets long-term. A lot of times these don't materialize into cash for a firm. And then other long-term assets, I'll give you specific instructions on your valuation for Renaissance Learning, what those other assets should look like. Okay. So we get our total corporate value, which is the value of the firm's operations. So that's $6 billion plus the sum of all of the non-operating assets for 7,989.72. We want to subtract out the interest-bearing debt for the firm at the end of 2018. And so that interest-bearing debt is going to be equal to, go down here under liabilities, the current portion of long-term debt plus short-term borrowings, which were both zero in this case, plus the long-term debt of the firm. There we go. I took out the ones that had zero value, and that was evidently the problem there. So the value of equity is going to be equal to the total corporate value minus the interest-bearing debt. If the firm had preferred stock, preferred equity, we would also take that out there. The number of shares outstanding, we go to the income statement again. Actually, let's go to the balance sheet and look at the total shares outstanding on the filing date of 71.9. You could either put that or the balance sheet date. It's not going to have a big difference there. And then our value per share is equal to $99.75. So I'm going to switch over to your assignment here in a minute. What we're looking for in the assignment is not really the price per share, because we're looking at an acquisition situation. So a firm is just going to buy all the equity, or actually not all the equity, the entire firm of Renaissance Learning. And so the number that you're going to want to focus, the numbers that you're going to want to focus on is the value of operations and maybe the total corporate value here, depending on what's in here. So if the other non-operating assets would move with the firm, you want to include them, but generally in an acquisition situation they're not. And so you're going to look at just the kind of those value of operations. So that's the valuation for Oshkosh. Let me know if you have any questions about how I estimated that and went through that. I went through it pretty quick because we took a longer time on Coca-Cola, and this was just to show you how to calculate the weighted average cost of capital, how to calculate the value of the firm today if we had non-constant growth. I do want to do one other thing here. And assume, because one thing you're going to have to do for your case is you're going to have to recalculate that cost of equity, assuming a different capital structure for the firm. So you've got Renaissance Learning by itself, as it is, and then you've got Renaissance Learning as it will be if it's purchased by one of two companies. So you've got Play-Doh, which is one company, and you've got Permira, which is another company. And how they're going to finance that acquisition is going to impact the weighted average cost of capital for the firm. So I just want to show you how to recalculate that beta using a different capital structure. So the first thing we need to do is unlever the beta. I'm going to change the font size so it's easier to see here. So the first step in determining a change in the required rate of return on equity due to a difference in the capital structure of the firm, or a change in the capital structure of the firm, is to first unlever the beta. So we've got our beta up here of 1.92. We're going to unlever that by taking the beta divided by, and then in parentheses, 1 plus, and you can see me typing it in up here, 1 plus, another parentheses, 1 minus the tax rate multiplied by the debt to equity ratio. So we're going to take the amount of debt divided by the amount of equity, or you can also take the weight of debt divided by the weight of equity. It's going to give you the same answer on here. And we get a new beta of 1.52, and notice that it is smaller than the beta up here. So this is the levered beta, this is the unlevered beta, and the unlevered beta for a firm should always be less than the levered beta, the beta of the firm with debt and the beta of the firm without debt, unless the firm doesn't have any debt to begin with, and they're just the same beta. Okay. So now we're going to relever it using a different capital structure, and the capital structure we're going to use is 50% debt and 50% equity. Let me go ahead and preemptively change the font here. Okay, so we're going to again use the Hamada equation, but we have to turn it around a little bit. So we're going to say that the levered beta using 50% debt and 50% equity is equal to the unlevered beta multiplied by 1 plus. So notice there in the equation up here, I took the levered beta of 1.92 and divided by what I'm about to type in, 1 plus 1 minus the tax rate. Using the same tax rate here, but that may not be the case if you've got an acquisition occurring, times the new debt to equity ratio. The new debt to equity ratio is 50% equity and 50% debt. Or sorry, reverse that. 50% debt to 50% equity, it's actually just equal to 1. But I'll put it in here, 0.5 divided by 0.5. I'll put that in parentheses too, so it doesn't get confusing here. So that's just equal to 1. The debt to equity ratio is then just equal to 1. And then I close that off. I get my new number of 2.74. So notice that we increase the amount of debt in the capital structure from 24.55% to 50%. And that had a fairly large increase, resulted in a fairly large increase in the beta, going from 1.92 to 2.74. Okay. And so the new cost of equity new cost of equity is going to be equal to the risk-free rate plus the new beta of 2.74 times the required rate of return on equity. Oops. Oh, sorry. The market risk premium. So it's 17.70%. So we see an increase there. So we increase the debt, increase the required rate of return on equity because it increases the risk to the equity holders. And then the required rate of return on debt, in this case, we're going to say it's not going to change, although it might go up. I'm going to give you those interest rates in the case for Renaissance. And then we have our weights of debt and equity, and because it's going to be a 50% of each, so it's just weight of equity, weight of debt, which is 0.5, 0.5, so our weighted average cost of capital is then equal to the weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate plus the weight of equity multiplied by the new cost of equity. So we're 10.63%. So it lowered it because even though the required rate of return on equity increased, we're using more of the cheaper financing source of debt in this case, and we didn't adjust the cost of debt up, which it might increase for a firm taking on that much more debt. All right, so I hope this is helpful for you. I've tried to mirror fairly closely. There's a little more work you'll have to do with the case study. And so now I'm going to open that up. It's out there on D2L for you. All right, I'm out here on your assignment for next week. So we've got the assignment here, and it says complete the free cash flow calculation. The amounts for depreciation expense can be taken from the statement of cash flows. Use the tax rate of 37.5% for 2008 because one isn't given. Using the information from Table 8, calculate the required rate of return on RLRNs, which is Renaissance Learning's ticker symbol, using the capital asset pricing model with the yield on the 10-year U.S. Treasury as the risk-free rate and the implied equity risk premium as the market risk premium. So I have on the spreadsheet market risk premium. It's the same as the implied equity risk premium. That was taken from a website. I believe I've mentioned him in class before, Aswath Damodaran. His website is where that was taken from. And so you were given a growth rate of 13.5% for 5 years and then 3% thereafter. So just like what we did with Oshkosh, you'll calculate the value of operations. Oshkosh has, Renaissance has a revolving line of credit. And let me explain what that is fairly quickly. It's like a credit card for a business. So, with your credit card, if you've got a credit card, it probably has a credit limit on it. So let's say it's $10,000. If you go out and spend $5,000, it only has $5,000 less for you to borrow on. Okay, and if you borrow that other $5,000, you're out of money to borrow on your credit card. But if you pay down that original $5,000, it opens back up the entire limit of $10,000. So let's say you go out and you have a $10,000 credit card, you borrow $3,000 on it. It got $7,000 left for you to borrow. If you paid off the $3,000, the $10,000 again is available to you. And that's how a revolving line of credit works for a business. The only difference between the two is if you use your credit card, you get a grace period of usually 25 days. Businesses don't get a grace period. They pay interest on whatever they've borrowed for any day. But in general, you can think of it as like a credit card. So assuming the revolving line of credit is fully utilized, the capital structure of RLRN, based on Permira's proposal, it would be 44% equity and 55.6% debt, result in a debt-to-equity ratio of approximately 1.25. So what I ask you to do is to
use the existing beta for Renaissance Learning as the unlevered beta, and then relever that beta, just like what I did in the for Oshkosh, with the new debt-to-equity ratio. Number 5, estimate the required rate of return on debt based on Permira's proposal as a yield on the 10-year U.S. Treasury plus the BB Corporate Index spread. So we assume that, based on their financials, with the amount of debt that Permira would use to purchase Renaissance, that Renaissance would then have to take on, that would be have a corporate bond rating of BB. And so we'd want to use the index spread. So how much on average do companies that have a BB credit rating or bond rating on their bonds, what is the yield on that versus the yield on the 10-year U.S. Treasury bill? Or Treasury note. And so that's going to give us an estimate for the expected cost of debt for Renaissance under that situation. And then I asked you to calculate the weighted average cost of capital. I asked you to calculate the value of operations. And then I asked you to list other firm-specific risks. So you might go back and look in your notes about what is a firm-specific risk versus a market risk. And then question 8, the last question: should the value of RLRN to its existing shareholders, so before it gets sold, the value of RLRN to Permira or some other value be used as the acquisition price of RLRN? Okay, so that's just something for you to think about, and really do spend some time on that, because it's going to come back up next week when we go over this, and I give you a little follow-up assignment on Renaissance Learning. So this is a case I wrote. I had published, I think, 3 or 4 years ago, and it got to be a very interesting case as I got into it. You had this couple, the Pauls, Judy and Terry Paul, who started up Renaissance Learning back in the 80s, and it was part of my childhood because the school I went to used the program, and I'm trying to remember what it's called now. It should be in here in the case. But I found a lot of people remember this program. And by the way, it's still around. You can still find it out there. If you go to a bookstore and look in the kids' books, it's called Accelerated Reader. So you might remember Accelerated Reader program. I remember it from being in grade school. Over time, it went from paper quizzes and paper tests to online. Of course, when I was in grade school, we didn't have the computer tests, but you may have done this online. So what they do is they take books and they identify the reading level of the book, and then they put out quizzes over the book to test your reading level, your reading comprehension and vocabulary using those books. It's an extremely popular program. The Pauls started it when their kids were young, and they actually homeschooled their kids, and they wanted to create a way for them to learn how to read well, and other people started asking for it. They heard about it, they asked for it, and so this company kind of organically grew out of that. So it's an interesting story. I'll ask you not to look up what happened in the end, because you'll see in the case that it went from, it kind of turned into a war between Permira and Plato Learning. So Plato was a competitor of Renaissance Learning, and Renaissance wanted to sell their company, and I'll explain why that was after you finish the case. It becomes a little bit important, and again, you obviously can look up what happened online, but it's not going to help you too much to do that. In fact, if you use the values that eventually happen, your values will be wrong. So you might save that and let me reveal that next week. But there were some interesting things that really happened here, and And I look forward to reviewing the outcomes with you next week. If you have any questions about it, let me know. There's a lot of information here, and most of this is to just kind of explain what's going on, where the cash flows are coming from, what the risks are to this firm, and things that a firm acquiring another firm might want to consider. So that's it for this week. Please, this is kind of a little more complex of a case. Let me know as you come across questions. Please don't wait till the last minute to begin working on this, and I look forward to hearing from you soon.